Did you know that assets are the lifeblood of any business? They play a crucial role in generating profits and ensuring the success of an organization. But have you ever wondered what exactly constitutes an asset and how they are categorized? Join me in this informative video where we'll explore the captivating world of assets in accounting. Unlock the secret to financial success with Kountin Koins, where numbers come alive and your accounting game thrives. Alright, let's get right into it. Assets in accounting. Assets are one of the fundamental building blocks of the accounting equation, standing alongside liabilities and equity. They play a crucial role in the operations and profitability of businesses. In this video, I'll break down the definition of assets in accounting and guide you through the various types of assets you'll commonly encounter. As accountants, we love categorizing into different groups such as current, non-current, tangible, or intangible. By the end of this video, you'll have a solid understanding of these asset categories. So let's dive right in. When we think of assets, we often envision things we own that have value and are useful. And you know what? That's not far from the truth. In accounting, assets are defined as probable future economic benefits obtained or controlled by a specific entity as a result of past transactions or events. While this definition may initially sound complex, let's break it down to make it more understandable. The term probable in the definition emphasizes that assets represent future economic benefits that are likely to be realized. It's important to recognize that the future is uncertain, and as accountants, we often have to make estimates and assumptions. For example, if your business has 10 clients who owe you money, can you guarantee that you'll receive every penny? Unfortunately, that's not always the case, as some clients may go bankrupt or dispute invoices. To account for this uncertainty, accountants make allowances for doubtful debts, estimating the portion that may not be recovered and recording it as an expense. This ensures that businesses provide for situations of uncertainty. Next, let's delve into the concept of future economic benefits that assets bring. Think about your car, for example. When you first purchase a brand new car, it holds significant value. But as the years go by and you drive it extensively, its value gradually depreciates. In 5 years, will your car still have the same economic value as when you first bought it? Unlikely. Its useful life will have decreased, and its resale value may have significantly diminished. This is where the estimation of useful economic life becomes crucial. Accountants assess the projected lifespan of assets like cars, and based on the estimate, they gradually reduce the value through depreciation until it reaches zero. While these estimates may not be precise, they provide a practical way to assign value to assets. Lastly, the definition mentions that assets are obtained or controlled by a specific entity. This highlights the concept of substance over form in accounting. When preparing financial statements, we prioritize the economic substance of transactions over their legal form. Let's consider an example where a business leases a building for 60 years. Legally, the business is considered a lessee and doesn't own the building. However, from an economic perspective, the business effectively controls and benefits from the building for the majority of its useful economic life. By adhering to the principle of substance over form, accountants treat the building as an asset, even if it's not legally owned. This approach has significant implications for accounting and tax treatment. Now that we have a solid understanding of the definition of assets, let's explore some practical examples of common asset types that you should familiarize yourself with. But before we delve into those examples, let me give you a quick overview of a balance sheet. Think of a balance sheet as a snapshot, capturing a specific moment in time and showcasing a business's assets, liabilities, and equity. In the asset section of the balance sheet, we list all the different types of assets that a business owns or controls. These assets are typically arranged in order of liquidity, which refers to how quickly an asset can be converted to cash. Based on this concept, assets on the balance sheet can be divided into two main categories: current assets and non-current assets. Let's explore each category further. If you've liked the video so far, please give it a like, subscribe, and let us know in the comments what you would like us to cover next. Now back to the video. Current assets are the agile assets, the ones that can be converted into cash within a short period, typically within a year. The most common types of current assets include cash, accounts receivable, and inventory. Cash is the most liquid asset, representing the funds readily available to the business. Accounts receivable refers to the money owed to the business by its customers, which will eventually be converted into cash upon payment. Inventory represents the physical stock of goods that a business intends to sell to generate profits. Additionally, current assets can also include prepayments and short-term investments. Prepayments occur when a business pays for something in advance, such as rent. Although prepayments may not be converted into cash, they are considered assets because they provide a future economic benefit. Short-term investments are made when a business has excess cash that it decides to invest in stocks, bonds, or other securities for a short period, typically within a year. These investments allow the business to earn a return on its idle cash while maintaining liquidity. Moving on to non-current assets. These are the steadfast assets, the ones used in the long-term operations of a business to generate profits. Unlike current assets, non-current assets are not easily converted into cash. They can be categorized into three main groups: long-term investments, tangible assets, and intangible assets. Long-term investments refer to investments held by a business for more than a year. They can include investments in other companies, bonds, or long-term loans made to other entities. These investments are carefully selected to support future growth or generate income over an extended period. Tangible assets are the assets with a physical presence, those you can touch and feel. The most common types of tangible assets are land, buildings, furniture, machinery, and vehicles. These assets are essential for a business's day-to-day operations, contributing to its productivity and supporting its activities. On the other hand, intangible assets are assets that lack physical presence but still hold value. Examples of intangible assets include intellectual property such as patents, trademarks, copyrights, and royalty rights. For instance, if you're a photographer, you may own royalty rights to your photos, allowing you to receive compensation when others use your work. However, valuing intangible assets can be challenging, as their future economic benefit is difficult to quantify. Consequently, many businesses do not capitalize internally generated intangible assets, meaning they do not record them as assets on the balance sheet. Instead, they capitalize intangible assets acquired from external sources, recording them at cost or a lower amount. Over time, the value of these assets may be decreased through amortization. One notable intangible asset worth mentioning is goodwill. Goodwill represents the premium that one company is willing to pay for another company over and above the fair value of its net assets. For example, when Facebook acquired Instagram in 2012 for a significant amount, a significant portion of the purchase price was attributed to goodwill. These represented the value placed on Instagram's brand, potential future earnings, and synergies with Facebook, surpassing the fair value of its tangible and identifiable tangible assets. And there you have it. We've covered a lot of ground in this video, exploring the definition of assets in accounting and delving into various types of assets, from current to non-current, tangible to intangible. I hope this deep dive has provided you with valuable insights into the world of assets and their significance in financial analysis. What are some examples of assets that you encounter in your personal life? Don't forget to comment below with your thoughts, questions, and accounting victories. And make sure to hit the subscribe button and turn on notifications. So I'll see you in the next episode of Counting Coins. Happy accounting!